Hey folks, welcome back to the channel. Appreciate you taking the time out of your day to watch my little video here. So today we're going to be talking about the pandemic market, the real estate market between the years of early 2020 all the way through about, I guess, mid 2022 is when you might quantify that ending, depending on how you look at it. The effects that it had on the market, how it affects today's market, and what we might be able to learn from it moving forward. Now, before we get started, do want to make a quick little disclosure. This is not financial advice. Some parts of it may seem like financial advice, but this is just my honest opinion as an individual that works within the industry. So, for all you attorneys out there who are feeling a little litigious, sorry, not today. We're not going to be doing all that. So, why do I think this is important to talk about? Well, primarily, I'm really into history anyway. I always found it to be fascinating, and I think that to kind of understand where we are and where we may be in the future, it's important to understand what happened in the past and, kind of how we reacted to that and what lessons can we apply moving forward, and how we go about our day-to-day lives today. So to kind of set the stage a little bit as far as what happened, where did it all really start? So March of 2020, I think, is where most people would kind of consider the beginning amount. I don't know about you guys. I remember at the time I was watching the news, like I assume everybody else was, and we all thought that, I think they were calling like a 4% mortality or something like that. I don't remember the exact numbers. All I remember is we all thought it was going to be really, really, really bad. Um, and as far as how that was going to affect the housing market, well, people thought the economy as a whole was probably in for a pretty rough time. We thought we were going to have to shut down and, nobody leave their house for God knows how long until that gets figured out. So, South Carolina, and by the way, we're just talking about the SC housing market primarily in this video, but South Carolina, like just about everywhere else, we shut everything down. I want to say it might have been April, could have been March. It was around that early spring of 2020. Everything shut down. And that was, in that moment, we all kind of figured, well, it's probably going to have a pretty negative effect on things as far as housing. No one's going to be out buying houses. Nobody's going to be leaving the house that they're in right now. We were kind of wondering about, how it would affect if people can't work and nobody has any money and they get behind on their mortgages. How's that whole thing going to play out? Because there was that, that was in just the beginning stages of floating the idea of the, eviction pause and this, that, and the other, and foreclosure pause and all that fun stuff. But in the coming months, what we saw happen in South Carolina was, I believe it might have been May or June. I'm not sure. It was about 2 months, give or take, if I remember correctly, where Governor McMaster pretty much said, hey, at least in South Carolina, you do you, go handle your business. You guys can just kind of do whatever you want. Maybe don't go, kissing any strangers. But for the most part, you go handle your business at your own risk. And a few other southeastern states, and I think Texas, and I don't know, every state had their own little way of handling it. Some states shut things down or took a maybe more conservative approach, be a gentle way to put that, more conservative approach than others in regards to stopping the spread and this, that, and the other. But that does come into effect later. So either way, economy shuts down, at least on paper and in theory. And the Fed starts taking action to kind of restart the economy or give it a little bit of a boost, or at least that was the idea. So part of what drove the housing market, and if you haven't heard, in the pandemic market, prices went up like a lot. It was skyrocketing, and a lot of that had to do with interest rates being so low. So I wanted to kind of start there and talk a little bit about that. So a couple misconceptions about how this happens. A lot of people to this day still believe that the Fed, and when they say the Fed, for the record, they're talking about the Federal Reserve, not necessarily the federal government. Those are kind of sort of not the same thing. We'll make a whole video on that later on down the line. But, a lot of people think that the Fed controls the mortgage rates, and that's not necessarily the case. What they do control is the Fed rate, and they do kind of sort of, you'll see a little bit later in the video, they tweak certain things on their end to kind of indirectly, or some would argue directly, influence mortgage rates. But the first thing they did was they dropped down what they call the Fed rate, officially the Fed borrowing rate, and they dropped that down to about 0%. Now, what is that actually? Without going too much into detail and making this like a, boring economics video, basically the Fed rate is the rate that banks charge each other when they're lending each other money. That's a gross oversimplification of it, but it's not necessarily, actually directly lowering mortgage rates or even credit card rates or anything like that. What it does do is it puts more money in banks' pockets. And the reason that matters is that banks, just like everybody else in the business world, compete against one another for your business. They want you to spend money with them. So when they save a little bit of money, they in turn can pass on those savings to the consumer. And you can look at that whether that's out of the kindness of their own hearts or in the spirit of competition. Regardless, if one of your competitors has a lower rate than you, then maybe they're going to end up getting more business. So when they have a bit more meat on the bone, so to speak, in terms of margin, they pass that along to the consumer so that they can stay competitive. So that's the first way things go down. But in my opinion, my humble opinion, again, remember, not financial advice in any way, shape, or form. But in my opinion, that didn't really actually have, not that it didn't have an impact, it didn't have the biggest impact. It's not what caused this whole massive explosion that we saw in the housing market. And we'll get into some of those numbers in just a little bit. The two things that had the most impact, as far as I'm concerned, number one is something called quantitative easing. Now that's fancy Federal Reserve talk for just buying up a bunch of bonds. So to put it in perspective, a little bit of a explanation into what that means. So what the Fed does is they go into the bond market and they buy a whole bunch of them. Now, why would they do that? Well, the idea is to make things more affordable for consumers, particularly in regard to mortgage rates. And so when they buy these bonds, just like anything else, when you have more demand, the price goes up. And when prices go up, yields go down. So the price gets more expensive, the yield on those bonds becomes lesser. And that's important because mortgage rates have an inverse relationship with bond yields. So the yields have an inverse relationship with the price, rather. So when the price goes up, the yields go down, and the mortgage rates tend to follow that. So when there's a lower yield on bonds, there's going to be lesser interest rates on mortgages. All right. So that's the first thing they do. And they've done this before. So if you want to track the mortgage rate, it's not going to be a one-to-one comparison in terms of what the percentage is on the 10-year bond versus what the percentage is on a mortgage rate. But almost every time, not every time, but more times than not, if you see the 10-year bond doing this, then usually you're going to see the mortgage rates do this. I'm talking about the yield, by the way, not inherently the price. So if the yield's going up, usually the mortgage rates are going up. If the yield is going down, usually the mortgage rates are going down. It's not going to be the exact same percentage on the yield to the mortgage rates, but you'll almost always find them in the same trajectory. But like I said, the Fed has done this before. This was kind of their primary tool in 2008. If you remember that whole fiasco, some of you were probably too young for that, but short explanation, housing market blew up because there was a whole lot of fraud. We'll make a video on that later. Probably hear me say that a lot today. But the third thing they did, and this is where we got into really unprecedented territory, is they started buying up MBSs. Now, I'm not an expert on everything the Fed has ever done. I'm not going to pretend to be. So at some point, have they ever bought an MBS? I don't know, maybe, perhaps. But the quantity and the rate at which they were buying these was really, really unprecedented. And it was direct intervention into the housing market. Now, a couple things to remember. The Fed impacts policy on a national level. And so it's not state specific, and that'll matter a little bit in a little bit when we talk about it going forward. But Fed's making moves nationally. So maybe, when you look at why they make some of these moves, it might make sense in a state where they're limiting all economic movement and they really need that fuel. And maybe it doesn't make as much sense in a state that largely wasn't, not unaffected, but it didn't have as much of an impact in some states, at least from an economic standpoint. So anyway, what is an MBS? Basically, MBS, mortgage-backed securities, as it's more formally called. MBS is kind of like a package deal. So if you don't know, when lenders give you a loan on your home, maybe you buy a house, costs you $500,000, you put $50,000 down or something like that, and the bank or the lender, whoever says, here's $450,000 for your house, pay me back in 30 years, or, along the way. Now, oftentimes, the lenders, they don't have billions and billions and billions of dollars. when they give out that loan, usually what they need to do is turn around and sell that loan, and then they can do more loans. And so when they make, when they originate your mortgage, the vast majority of lenders are then going to go ahead and turn around and they're going to sell that. And that's usually sold packaged and bundled up with a whole lot of other mortgages. And that's called an MBS. It's like you take a bunch of mortgages, you bundle them up together, wrap a bow on it, and say, this is an MBS. And you can buy shares of an MBS, or you can buy the whole thing, whatever you want to do. So what the banks do is, not the banks, what the Fed does is they go in and they start buying up all these MBSs. And what happens there is, of course, just like the T-bond, when they buy more of it, when the demand goes up, the price of it starts to go up. And the reason that matters is these lenders, when they're selling the loans, as they do, with some exception, they can sell it for more money. So they're making more money when they sell the mortgage than they would be previously. And what that allows them to do in order to stay competitive and have a greater advantage when they're trying to solicit business from any one given borrower is they can decrease the interest rate. Because since MBSs are worth more money, and since they can sell that loan for a higher dollar amount on the secondary market, they don't have to charge as much on the interest rate. And so in my opinion, keyword, my opinion is that this action in the MBS market probably had the greatest impact of the three in terms of interest rates. But that's just my opinion. That's what I think. And again, this is kind of unprecedented for them. They haven't done a lot of this in the past. If they have, I'm at least confident in saying that it wasn't to this level. So again, interest rates drop, things go a little bit crazy in the housing market. But the thing about it is most people kind of stop there when they reflect back on this pandemic market. They kind of oversimplify things and go like, oh, well, it was, low interest rates, people want to buy houses. And to be clear, that was a massive, massive part of it. But there were a few other factors as well I want to talk on. Now, the housing market, obviously, it's very localized. And so this is where we get a bit more state specific. So a couple things about it. The state of South Carolina, whatever your opinions are on whether this was a good thing, bad thing, that's not, what we're going to sit here and talk about or debate today. That's for another, probably a whole other channel. I don't think we're going to get too political on this one. But the point is South Carolina largely stayed open for business, at least relative to most other states in the union. All right, we were there with Florida and a few other states in the Southeast, Texas, that took a very kind of hands-off approach. There was guidelines, we recommend that you stay 6 feet away from each other. Again, don't go, hugging up on everybody maybe as much as you would. Do some Zoom calls if you can. But for the most part, comparative to other states, South Carolina let you stay in business and let you do your thing. And so the first thing outside of the rates that drove the South Carolina market so much is we had so many people moving into this state. And it was for work reasons. People wanted to move here. A lot of people, again, I'm not going to talk into my political opinions, but a lot of people did have political opinions at the time. And I remember a lot of buyers who were coming in from out of state and they would talk about the politics of it all. And they just didn't like the way things were being handled. Whatever your opinion is on that, a lot of folks were moving in for those reasons. So we had a massive influx of interstate migration into South Carolina. So we had people moving in, and the problem, or depending on how you look at it, the problem, the good thing, however your perspective, the reason that had a positive impact on home prices is because we had more people than we had houses for sale. At one point in time in the Charleston MLS, we had it was like 500 or something. I don't know the exact number. It was a very low amount. And for comparison, we've got 5,200 houses in the MLS today, something like that. So we had really, really limited supply. And one of the things people were trying to do is they were trying to increase inventory, all these home builders out there. And as much new construction, if you guys are local, as you think you've observed in South Carolina, they weren't able to build them fast enough. And it wasn't that these builders didn't want to build houses. We had people that were selling them months and months and months before they even broke ground in certain situations. They wanted to build them, but they didn't have the supplies. And this is where it gets, more tied back into the pandemic is obviously this wasn't a localized thing. This wasn't a South Carolina thing. This wasn't an America thing. This was a global issue that we had to deal with. And as open for business relatively, again, as South Carolina was, a lot of the world wasn't like that. And it was particularly tricky with shipping between countries. If do so much import in America and especially in South Carolina, that was a lot trickier than it used to be. And so, building materials, lumber, all that stuff, it was all backlogged. And so they couldn't build the houses fast enough. So again, the people are coming, they're coming no matter what. And it just gets trickier and trickier to even get the houses built in time. We had properties that were selling, 4 months before they're done. And then by the time the house is built, that same home in that same neighborhood was selling for like 20 or 30,000 more. That happened many, many times, during this pandemic market. And, that's just kind of the way it was. But a lot of that, again, goes back to basic supply and demand. And so it was, yes, the interest rates were low, but it was also, at least in South Carolina, we just didn't have enough houses relative to the amount of people that were trying to buy them. And so that became very tricky to keep prices low, because anybody selling any product, I don't care who you are, everyone likes money. And so if you got 10 different people trying to buy the same thing, yeah, the price is going to go up. All right. That's just basic elementary economics there. All right. Nothing too controversial there. Now, how much exactly did the prices go up? Well, I've taken the liberty of writing this down so nobody can fact check me in the comments later. If you have any problems with it, I got this data from redfin.com. So if you think the data's wrong, go write them a letter. But this, by the way, is a national median home value prices. In case you're curious, it's not state specific. This is national median. I just want to kind of spell out exactly what happened to home values and why this was such a significant impact. So we'll just start in March of 2020. At that point in time, the median home value in the U.S. was $260,000. By that same time next year, March 1st, 2021, it jumped up from 219 to from 260 to 299. So pretty big jump. But then from 2021 to 2022, you saw that number jump from 299 to 349. And then all the way up to its kind of, pandemic peak, you might call, all the way up to 380 in June 1st, 2022. So let's just be clear. March 1st, 2020, 260. And then June 1st, 2022. So that's what, like 2 years and 3 months, something like that. From 260 to 380 in like 2.25 years. For those of you who don't know, that's a lot. That's a pretty historic jump in such a short period of time. And so another thing I wanted to talk about in this video was kind of, what some of the gurus were saying. And we heard it a lot working in real estate. We heard so many different people with so many different things to say. And, one of the things you kept hearing over and over and over was that, this market is on such a tear. People would throw around the bubble word. We're in a bubble. And again, this is a part where I start to, I want to remind everybody that this is not financial advice. This is my opinion. This is for entertainment purposes, whatever I need to say. Look, it's not financial advice. Let's just go ahead and be clear about that. But here's what happened. You had a lot of people who were saying we're in a bubble. This is unsustainable. This cannot continue. The market is going to crash. And that's what they were saying. I remember hearing it all the time. People were saying that. Then you had other people on the other side of the spectrum, and I'll admit I heard this quite a bit less, but you still had people that were saying, this is going to go on for years. There's no end in sight. People are going to keep moving here. This is just going to keep on, it's going to go on a tear forever, or not forever, but, basically for a very, very long time. And a lot of people were saying 10, 15, 20% annual equity gains. That's not going anywhere. And this is where you got a lot of people who, personally, I think you're probably putting yourself at a lot of risk here, but I even saw agents saying that, and I think that's a little bit unethical. We'll get into that in a minute as well. But, you saw a lot of people who were extraordinarily pessimistic, and you saw a lot of people who were extraordinarily optimistic. So we'll just go ahead and address the first one first. Spoiler alert, the market didn't crash. We're good. But I'll tell you a little bit about what did happen. So June 1st, 2022, that was what I call the pandemic peak. And the reason that matters is around, I can't remember if it was exactly May, June. It was somewhere around that area. It was May or June in 2022. And we saw a really, really rapid shift. And by the way, just to give you a little bit of context, interest rates had kind of crept up by early 2022. They weren't at like 2020, 2021 levels where you saw 2% all the time. But they were still low. There were still rates in like the threes and the fours and that type of thing. So it was still pretty low. And then in, we'll just say late spring, early summer of June 2022, you saw a really sharp increase in interest rates. And when I say sharp, I mean like from 4% to 6% in a matter of like a couple months, give or take. Don't quote me exactly on those numbers, but it was a pretty sharp increase. And that's a huge impact as far as monthly payment goes in a very, very short amount of time. So this was kind of like a, it's like the market getting a left hook from Mike Tyson. That's probably the best comparison, I can make here. And so a lot of those people who were going on that whole, this market's going to crash, we're in a bubble. This was their like, that's the bubble pop moment. This is when things are going to crash down. They say, we've been telling you for years now, a couple years, and then here it is. So what happened? June 1st, 2022, $380,000. That's the pandemic peak. And then it bottomed out. It bottomed out in February 1st, 2023. It took about 7 months to get there. And it bottoms out. Where does it bottom out? It bottomed out at 340,998. So, granted, that is into what we call correction territory. Like, yes, the market corrected, but this idea that, it was going to just 2008 collapse, nah, that didn't really happen. And so it bottoms out in February of 2023 at 349.98. Jumps right back up a little bit. We're going back to March numbers. March 2023, I'll just read them off. March 2023, 349. March 2024, 366. March 2025, 378. March 2026, back to 380 again. And then July of 2026, the most recent data we have, it's at 408,776. And so, what actually ended up happening? Well, a couple things. Number one, I wouldn't consider that really a crash. We saw a correction, which I think personally was probably necessary. We saw a correction in the market. A lot of that had to do with the interest rates going back up. And in case you were curious, around that same time is when the Fed increased the Fed rate. They backed off on quantitative easing and MBS buying and all that stuff. So obviously the rates go do that. So you see this go down to 340. It's about what is that? I don't know, somewhere between 12%, give or take. Quick math in my head. Somebody put the exact number in the comments, please. But you see that correction, and it happens over about a 6-month period of time. And so, yeah, the market fixed itself, but it didn't crash. And as far as those people who were saying, it's just going to tear forever, that obviously didn't happen either. Now, do we see post February, do we see consistent growth again? Yes. From 2023 to 2024, 2025, 2026. Yeah, absolutely. We do see growth, but percentage-wise, it's a lot more stable. It's a lot more what somebody might call normal. And in my opinion, there's no such thing as a normal market. It's all relative, but it's back in line with historical trends. You can say that. Things are a little bit more balanced. We're still seeing equity growth, but we're not seeing it at massive levels. So a couple things, what did we learn from the pandemic market? So for me, first thing I think of is maybe the Fed could have chilled out a little bit. Now, I'm a little biased here, and I did say I wasn't going to get political, but I don't think this is political in my humble opinion. Because by the way, the Fed doesn't get elected. I believe it was Jerome Powell, I think was the guy. And I'm pretty sure he was the same dude under like Obama, Trump, and Biden. And then we got a new guy now. But, under like 3 different presidents in both parties, I'm pretty sure it was still Jerome Powell the entire time. So, I don't think it's political. Point is, I think the Fed probably did not need to take as aggressive steps as they did. I think that you could make an argument for maybe in certain states where the economy really, really did need Some fuel put on the fire. Maybe it's appropriate there, but from a national standpoint, I don't think it was necessary. South Carolina, certainly, we didn't need all that fuel. I think if you were to, even do the Fed rate and the T-bonds, that probably would have been plenty of fuel. I don't think we really needed to go in there and do all that MBS stuff. That's in my opinion, what I think I learned from it is, there was a bit of an overreaction as far as federal assistance went, in terms of stimulating the economy. I don't think that fire really ever went out, at least not in our state. And I don't know if we needed to fuel it as much. So that's the first thing. Second thing, well, maybe some of you guys have learned this. I've always been yapping about this. Don't listen to anybody who tells you they know what's happening in the market. And part of the reason I make this little disclosure when I make this video, this is not financial advice. Part of that's a don't sue me statement, but a big part of that as well is that it genuinely is not. Anybody, and I mean anybody, I'm talking about doctorates of economics, the smartest guys on the planet. All right. Nobody knows what's going to happen with the market. They may think, they may have a good idea, they may have a solid guess, and maybe one person's guess is a little bit more reliable than another person's guess. Doctorate of economics, a guy who does this for a living probably knows better than, your Uncle Jim Bob, but nobody knows. It's all just varying degrees of how good their guesses are, but still a guess nonetheless. And that's what I think everybody should take away from this, because those people who were saying it's gonna crash, that wasn't just, crazy folks saying it's gonna explode and crash tomorrow. That was really, really educated people who were saying that. And on the flip side of that, people who were saying it was going to continue to go up, that was really, really educated people who were saying that. And so, it's not that you shouldn't make an effort to be informed. It's not that you shouldn't make an effort to stay on top of these things, but nobody's recommendation should be taken as gospel. All right. Because it's ultimately just guesswork. I personally believe that for the vast majority of home buyers, this is a very personalized process. This is a very intimate process. And as much as the numbers matter, and everyone obviously wants to, make as much money as we can in everything we do. And if we make an investment, we want to make sure it's going to go up. For most people, I don't think home buying shouldn't be something that you do exclusively based on economic factors. Now, does that mean you should at any point try to go outside of your means in home purchasing? No, I think you should never do that. If you can't afford something, don't buy it. But in terms of trying to time the market, that type of deal, don't do all that. Buy a home when it makes sense for you. Don't try to time the market, all right? Unless you're doing it purely from if you're trying to flip houses or buy rental properties, that's a little bit different. If it's a house you're living in though, buy it when it makes sense to you. Don't rush it if you're not ready, but you think it's the right time, and don't not do it because in a situation where you are ready, but you just heard somebody on, XYZ news network that said, oh, it's not the right time or whatever. Make it a you decision. So that's what I think a lot of people can take away from it, because what we were shown is that every single talking head on the internet, made some sort of a prediction, and none of them are right, basically. So before like that. Now, working in today's market, I'm kind of happy with the way things are going now, because what we've seen is we've seen a return to maybe not, again, I hesitate to say normal, because the housing market, if you look at it, is so, at least in my opinion, I'm a bit of a dork, but I think it's very interesting and it's very fluid and it changes quite a bit. But things that historically used to always matter, for a while there kind of didn't. And we're back to that sort of traditional, things sort of make sense again. And I'll give you a great example of that. One thing you always used to hear was, location, 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 right? That's the oldest thing you've ever heard anybody in the real estate world say ever, right? It's all about the location. Well, not during the pandemic, During the pandemic, I knew a lot of guys who who got into home flipping and property investment, and they're like, "Oh, dude, I'm like the Warren Buffett of flipping houses. I'm so good at this." It's like, yeah, well, you could have bought a rock, or a cardboard box on the side of the road, and it would have gone up 20% in value in a year. So, maybe not. Maybe pump the brakes a little bit on being Mr. Economic Guru. The entire market was exploding. You're not really, that great at that, respectfully. But that was the case. As much as some locations still outperformed others, and it wasn't that everything was equal, it was almost impossible to take a loss during the pandemic. And now we're kind of back to normal. I'll give you a great example. There's one neighborhood, and for example, new construction, you find this a lot worse. In some neighborhoods right now, despite what we talked about, a national average is still going up slightly. Some neighborhoods, you can buy a house, and let's say you bought it in 2024, and maybe right now in 2026, 2 years later, it might be worth what you paid for it. It could, in certain neighborhoods, particularly with new construction, it could even be worth a little bit less than you paid for it. How's that happen? In other markets, both in Somerville, mind you, you could buy a house, and then that neighborhood, the home values might have gone up 6, 7, 8, 9% in 1 year on average, or 2 years rather. Same town, same state, different neighborhoods, different locations, different factors. And so that stuff's kind of becoming a little bit more relevant again. And the fact is, not all neighborhoods are created equally. And in any market, a bull market or a bear market, when things are going up or going down, some things are going to do better than others, regardless. All right, it's kind of like a sailboat, like a sailboat race specifically. Think of it like this, right? So, if you're going north, if you and 5 other sailboats are racing and you want to win, and you're going north, and the wind is blowing at 50 miles an hour and it's blowing north, you're all going to get to the finish line faster, but one boat's still going to win and get there the fastest, and one boat's still going to lose and get there the slowest. You're all going faster in general, but there's still a winner. And let's say you're going there and the wind's blowing 50 miles an hour south. I don't know about sailboats, know if that's even possible, but let's just say it is. You're all going to go slower. Some of you might even go backwards, but somebody's still going to win the race. You see what I'm saying? And so I think that because things are maybe a little bit more balanced, maybe a little bit more competitive, I think that it's honestly, I like it a lot better. I think that it has changed the way people approach things a little bit. And I think people are making more intentional decisions with their purchase. If we go back to the pandemic market, it wasn't about finding the perfect house in the perfect location with the perfect price and the perfect terms. For a lot of buyers, for probably 90% of buyers, it was about getting a house. Yeah, we all love 2% interest rates, but you forget, we quickly forget that you couldn't really, you had anything in your budget that was available, you had to seriously consider making an offer, and probably making a pretty aggressive offer. Houses, at least in the Lowcountry market, houses were selling in hours, not days, not weeks, not months, hours. And within those hours, it was a multiple offer situation. I've got some lovely clients of mine. I'm not going to say their name because I don't think they'd appreciate it necessarily, or at least I wouldn't do that without asking. But, we went out there, and this was, I think, 2021. I think it was in March too, actually. In 2021, I believe, we went out there, and that house went on the market at 8:30 or 9 o'clock in the evening. We went out there at 11:45 at night and made an offer that night. And that's what we had to do to get the house, because it was just a crazy market. I bought my house in 2021. I think might have been 2020. I'm not sure. The one I live in now, there was, 2 or 3 others that we looked at, and, 8 offers within the first day of listing. And it was just crazy. And, forget about closing costs, forget about getting the seller to make repairs. All that stuff is off the table in, a 2% interest rate market. And so now people can breathe a little bit. It's hard to even make a decision like this, at least while factoring in all the variables within such a short period of time. You actually might, when you go see a house that you like, you got a day to think about it, to really, maybe drive around the neighborhood a bit more and make sure it's a good fit for your family. If there's something wrong, you can probably ask the seller to fix it. There's a good chance they'll do it. That's the type of market that we're in now. And for me, I think that's a lot more, I think there's a lot of value in that from the home buyer perspective, simply because, again, this should be a very personalized decision. This should be a very long-term decision. I always say it, I probably sound like a broken record, but this is Christmas morning. It's Thanksgiving dinner. It's, the neighborhood your kids are going to grow up in, and the, park they're going to play at, and the school they're going to go to. Yes, money matters, and it always will. And you 100% should factor that into the equation. But buying a home is a personal life choice, and it deserves a great deal of thought. And when you have a flaming hot market where you've got to make a decision in hours whether or not you want to make probably an above asking offer on this house to get it, man, that's hard. That's hard to put thought into it. So, you know, that's kind of where we are now. And I think moving forward, this is again not a prediction and whatever, blah, 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 disclosure, don't sue me. I think that rates are probably gonna hold steady-ish around this ballpark for a little minute. I think that home prices are going to maintain and probably go up very, very reasonably. And I think that's going to take maybe a while before we start seeing really aggressive gains again, probably just because, wages have to catch up. Anytime you have a high inflation situation, where home prices or the price of anything goes up drastically, eventually the wage market and the labor market will catch up to that. But typically when you see something rip up super fast, there's going to be either a correction or a massive correction, but in our case, just a modest correction, and then kind of slowly holding until wages catch up. And then you get back to your kind of normal, 2 to 4 to 5 or 6%, whatever annual growth, depending on that. A cool market used to be flat to 1%. A normal market was like 2 to 4%. And then anything over 4% was considered a hot market. And I think we'll kind of get back to that. Again, that's just my opinion. That's where I think things are going to be. There could be a new pandemic tomorrow. There could be, aliens invade, and that probably has an impact on interest rates some way or another. I don't know. You never know what's happening tomorrow, but I think we're going to be in a much more stable situation going forward, and I think it's going to be a lot more sustainable. What we saw before, like I said, I just think if the crash was going to happen, in my opinion, it probably already would have. We're about 4 years removed from, the interest rate shock that we got in 2022. Shock, that everyone saw coming eventually. But, if it was going to happen, I think we passed that point. So, that's where we are now. I hope you guys have found a little bit of value in this video. I hope you've been able to, maybe learn a little something about it. And if there's one thing I want you guys to take away, if there's one thing that you forget everything else, it's all just fun facts. This is the point that I really want to hit, is that home buying is a decision for you. I think home buying is a great investment. I think owning your home is a great investment. I think long term, I don't like people who predict short term things because I think they're either lying or they don't know any better. But long term, real estate has been very, very resilient, and it's gone up quite a bit in the long term. But even if you forget about all that, for me, for the average person, home ownership is a path towards a comfortable retirement from a financial standpoint. It's a 30-year mortgage. Once your home is paid off, you've still got taxes and insurance, but it's going to be a lot less. It prevents you from having to deal with rent hikes that happen over time. So I think that regardless of the market, from a long-term perspective, home ownership is almost always a safe bet. If nothing else, from a cost of living mitigation later on down the line once it's paid off. Versus just paying rent indefinitely. But again, if there's just one thing I want you guys to learn, it's just don't put any weight into the guys, the people that tell you, hey, you got to buy now because this market's about to skyrocket, or the people that are like, oh, you've got to sell now, this market's about to drop. Don't let any of that nonsense impact your decision one way or another. You're never going to hear me, on any avenue, in person, online, whatever, telling you, you've got to buy now because this market's about to blow up, or you got to sell now, this market's about to tank, or, I'm never going to make that prediction. And I don't think you should put any weight into anybody who does. I think if you want to be optimistic, you can say that they don't know any better. If you want to be pessimistic, you can say that, maybe they're just being a little bit, not as honest as they should be to try to make sales. So that's what I want you to take away. Make this a decision for you. Do it on your terms, and, give it the respect it deserves. So anyway, hope you guys enjoyed the video. Please do, like, subscribe, do all that other nonsense you're supposed to do on the internet. Share it, tell your friends, tell your mama, tell your cousin, blah, blah, blah. Ring the bell. That's a thing now. We got to ring the bell. So anyway, appreciate you guys' time, and I'll catch you on the next one.